Hello everyone and welcome to the online lecture series by Shet Vidya Mandir English High School and Junior College of Science and Commerce. Myself Jayesh Rajgur, and today we are going to study 12th Standard Economics, new syllabus, chapter number 4, Supply Analysis. And today's topic of discussion is revenue concept. My dear students, in the previous video lectures, we studied about the concept of supply as it is important to understand the producer's behavior. Supply is a microeconomic concept. Supply refers to quantity of a commodity that a seller is willing and able to offer for sale at a particular price during a certain period of time. Similarly, aggregate supply is a macroeconomic concept. It refers to the minimum amount of sales proceeds which entrepreneurs expect to receive from the sale of output at a given level of employment. In the previous video lecture, we studied about concept of cost. Today, we are going to talk about the revenue concept. My dear students, the term revenue refers to the receipts obtained by a firm from the sale of certain quantities of a commodity at a given price in the market. The concept of revenue relates to the total revenue, average revenue, and marginal revenue. Basically, cost was our expense and revenue is our income. Let us have a look at all these types of revenue in detail: total revenue, average revenue, and marginal revenue. Total revenue is the total sales proceeds of a firm. Basically, all the selling done by a firm. A commodity sold at a given price. It is the total income of a firm. Total revenue is calculated as follows. The formula is very simple, my dear students. Total revenue is equal to price into quantity. For example, if a firm sells 15 units of a commodity at rupees 200 per unit, total revenue is P into Q, that is 200 into 15, which will be 3000. Basically, total means the sum, or we can say the complete total of how much we have sold at a particular price. Let us move on to average revenue. Average revenue is the revenue per unit. Yes, my dear students, underline the word per unit. Average revenue is the revenue per unit of output sold. It is obtained by dividing the total revenue by the number of units sold. Basically, AR is equal to TR upon TQ, that is total revenue divided by total quantity. For example, if the total revenue of 15 units is rupees 3000, then the average revenue is calculated as AR is equal to TR upon TQ, that is 3000 upon 15, which will be 200. So the average revenue is total revenue divided by total quantity. Moving on to the next one. The next is marginal revenue. Marginal revenue is the net addition made to total revenue. Basically, the extra unit. Yes, my dear students, selling an extra unit or the total revenue by selling an extra unit of the commodity. Here, with this example, you will easily understand marginal revenue. For example, if the previous total revenue from the sale of 20 tables is rupees 4000 and from the sale of 21 table it is 4200. So, marginal revenue is nothing but total revenue previously minus total revenue currently, that is 4200 minus 4000, which is 200 per table. So in this way, my dear students, we have understood revenue concepts easily. As in this chapter, supply analysis, we studied the concept of supply, which is a fundamental economic concept that describes the total amount of a specific good or service that is available to a seller. My dear students, today we complete chapter number 4, Supply Analysis. It is important that you make quick notes and do quick revision through these video lectures. Stay safe, stay connected. Thank you very much.